Move now to the second paper. Michael Halling from University of Luxembourg. You're online. I think you are ready, so the floor is yours. Thank you.
Perfect. I hope you can hear me and you can see the slides.
Yes, we can see and hear you well. Thank you.
Perfect.
Thank you.
That's excellent. So thanks a lot to the organizers for putting the paper on the program, and my apologies for not being able to join you in Paris. Being in Luxembourg is not too far away, just around the corner, but I was unable to move some teaching obligations that I had earlier today, and that's why I have to join, unfortunately, virtually. But still, we'll try to explain our paper in the next 15 minutes to you. So this is joint work with Jean Yu from Monash University and Joseph Stechner from the WU Vienna. We're going to talk now about the different setup. We're going to talk about basically primary corporate bond markets in the US. So the questions that we're going to ask and try to address in our paper is basically two very fundamental ones that you see throughout the literature, I would say, in sustainable finance to a large extent. One is about the implications of ESG for financial returns. So basically the debate about whether ESG-based strategies earn higher or lower expected rates of returns, or what the impact of ESG-based strategies are on prices of green versus brown assets. And on the other side, of course, maybe the even more important question is whether financial markets through these channels have potentially an impact on the ESG characteristics of firms. So whether we observe any evidence that in response to potential pricing effects, firms, in their interaction with capital markets actually adjust in an optimal way their ESG characteristics to potentially benefit from these price differences. Now, we decided to study primary bond markets for several reasons. Because first, the identification, so to speak, of the cost of that capital is much more direct in bond markets, and in particular in primary bond markets, than compared to equity markets, in which expected returns are, as we all know, unobservable and have to be estimated. And so you basically run more into a model or sort of model-based risk. Another feature that we like about the primary bond market is that it's a well-intermediated market in which, at least according to our understanding, a lot of the information about the issuing company gets put on the table. And so basically the role of additional market frictions affecting the prices that are observable in these markets should be relatively small. And finally, it's a market in which some issuers repeatedly come to and basically repeatedly issue bonds. And that's exactly the kind of characteristic that we're trying to exploit in order to address this maybe even more fundamental question about whether we see any response by the firms in reaction to how they have experienced capital markets valuing or evaluating their ESG characteristics. Now, to give you an idea, given the limited amount of time of our results, and to make sure that I sort of can convey the main message of our paper, here is an overview of our main findings. So the main finding is basically that firms with better ES scores, and in contrast to the earlier paper, in our case, we unfortunately have to rely, or unfortunately for now, we rely on the traditional ES score methodology that is frequently used in academia, and obviously has certain limitations, and I might come back to that a little bit later. But firms with better ES scores pay on average lower credit spreads than firms with poor ES scores. So we find that these ES, or environmental and social dimensions, are reflected in the pricing of the bonds issued in the primary bond market. We do find that there is also an association to the credit risk that these firms incur. So part of these pricing effects can be explained by variation in credit risk. So put differently, ES scores reveal some novel aspects or are related to novel aspects in credit risk that are not captured by traditional characteristics of firms. What we do not find, and I think what's a particularly interesting result, is that we do not see any pronounced time series pattern. So we try to also study this question in a more dynamic fashion to see whether potential shifts in the preferences about green or high ESG investments are actually reflected in our pricing effect, and whether, for example, pricing effects are stronger nowadays than they were maybe 10 years ago. We find basically no evidence on any of these pronounced patterns, but also propose a potential explanation for this sort of missing evidence or this missing result. And that is that we see that there's a supply side response, again, linking back to my earlier statement. So we basically see that the supply of G bonds, so that means green or good, or whatever you want to call them, high ES score bonds, has increased over time, but attenuating or mitigating to some extent any kind of effects from the preference shifts that we would also have expected to see. Then we have a bunch of sort of more nuanced results, where basically we zoom into the overall ES score to better understand what kind of dimension of the ES score seems to be driving these results. Here, our evidence goes into the direction of product-related and employee-related sub-scores that seem to be most important. The environmental score, for example, only seems to matter in selected industries. And that's something that I will also refer a little bit back when I give you an introduction or an overview on our theoretical framework, because that's also consistent actually with a little bit how we think about the problem at hand. And finally, which is also a result that results directly from our theoretical framework and also other theories that have recently been proposed, is that actually this pricing effect of ES scores only matters for high yield bonds and BBB rated bonds. So for those kind of bonds where there is actually some risk involved, the more you go to investment grade and very highly rated bonds, the smaller the effect becomes. And again, that is particularly consistent with our theoretical framework, but also other frameworks in this literature. Now, in the interest of time, I will skip the related literature discussion. Obviously, we're not the first ones to study bonds, by no means. So there's a large literature on the interaction of ESG scores or sustainability in general and bond markets. I think the most novel aspects of our paper are really about the link to credit risk and also these time series dynamics about basically the response of the supply of bonds to these pricing effects that we find in the bond markets. So to basically structure our empirical analysis, we also propose or discuss a little toy model, which in itself is not sort of novel, but I think we kind of like extend it and take it from the equity markets, basically apply it to fixed income markets. It's based on the Heinkel, Krauss, and Zechner paper from more than 20 years ago. And the basic idea is, as you might know from this model and similar models that have been recently proposed, is that some investors only invest in G bonds, so these are again green or good bonds, while other investors are more neutral and they basically invest in G bonds as well as P, so they would be poor or bonds with low ES scores. And similarly, of course, you also have sort of these different types of issuers. And then the important part is that the firms in our framework can actually respond. So firms can make a costly investment in ES technology. So that's a little bit the link to the earlier paper. So they can basically think about an investment problem here to become green. And again, we model this in a very, very simple way, that there's basically some exogenously given cost that the firms are facing, and these costs actually in the end going to create some comparative statistics that we try to also link to our empirical results. And then the ES dimension has basically three mechanisms through which you can affect the pricing of the bonds. The first two are basically credit risk related. So there's variation in expected default losses, and there's variation in the riskiness of the bond payoffs. And channel 3 is resulting from these different investor preferences. So there's a demand effect and the resulting potential variation in the risk sharing between G and P bonds. And so if we solve for this model, just very briefly, then you see at the bottom line an equation that I'm not going to go through the details, but just to illustrate the structure of how we think about the problem is on the left side, you see the price difference. So that's the price at which a green firm can issue a bond minus the price at which a poor firm or a bad firm can issue a bond. And in equilibrium, that price difference is, of course, going to be exactly different to the cost of switching between being a green or a brown firm. Because if it weren't equal, then all the brown firms for which it would be cheaper to switch to green firms would do that. And so in the sense, exactly at this point, these firms where these costs of switching are identical or equal to this price difference are exactly indifferent between either becoming a green firm or remaining a brown firm and paying a higher price on their bonds. So that's the left side. And on the right side, you have the delta part, which is this first channel, which is the expected default loss or the expected differences in cash flows. And then in the parentheses, you have the first three terms are all linked to variances and covariances. So this is the risk channel. So there's the differences in the riskiness of of the bond payoffs. And the last part, if you look at this, if the last part of this equation, you see an IG over IN, so that's the fraction of the green investors over the neutral investors, and that's the demand channel. And here you see, again, similar to, for example, the paper by Van Winsbergen, Burke and Van Winsbergen, you see that this demand channel depends crucially on this correlation part, which is the last component, the correlation squared between green and polluting firms. And here you see if these firms, if these sort of these, you know, the bond payoffs are identical, so the correlation is either +1 or -1, then this demand channel is going to collapse and is going to break down, because basically bonds become perfect substitutes. And that's, for example, a link between the theory to motivate that in the end the effect should be stronger for those bonds that are risky and for those bonds where there's actually variation and in the riskiness, and so they're not perfect substitutes of each other. Now, to disentangle a little bit these different mechanisms, we're going to try to kind of, you know, go through a sequence of empirical tests that, first of all, you know, link the ES score to credit risk to basically identify these first two channels, and then also exploit this time series dynamics exactly to kind of see whether preferences matter, or if we find the responses in the supply, which will be consistent with the model. And so basically, you know, that's a little bit to give you an idea about how these things relate. As a last statement about actually this expression, if I go back one more time, then of course we can also use this model to motivate that in certain industries, for example, where the adjustment costs to switch and become a green firm are very high, in those industries, or for these dimensions of the ES sort of methodology or concept, you would expect the price differences for the bonds to be larger, because it's more costly for firms to adjust. So supply has more difficulty to adjust to speak to variation in demand. If there's other dimensions, for example, or other industries in which adjustments are relatively easy, then in this case you would expect firms to adjust relatively quickly, and as a consequence, you would observe small or no price differences between the bonds issued by green or polluting firms. So that's a little bit how we think conceptually about structuring, you know, the problem. And then we go to the data, which is, I think, a relatively standard data setup in both in terms of the bonds as well as in terms of the ESG information. So we use panel regressions in which we try to explain variation in the spread and linking it to ES scores. So we drop the governance part and just focus on environmental and social aspects, plus a whole bunch of controls that we just take from the literature that has studied primary bond markets before, and a bunch of industry and year fixed effects. The bond data comes from Mergent FISD, and the ES scores come from KLD. And again, I think all of these databases are well known, so I will not go into the details. Now, as I said earlier, if we don't find the result, for example, if we don't find that ES scores matter, or that some subscores matter for price differences for these bonds, then there's different explanations, right? Maybe they're not important, so they're just not relevant, obviously. The other one is that, you know, because the polluting and green bonds are close substitutes, there are no risk differences and there's no demand effect. So in that sense, you know, they might matter, but basically in equilibrium it doesn't play out, so you don't see them. Or as the last argument is, it could also be indicative of variation in adjustment cost, and that basically again supply adjusts for a certain dimension very quickly, because it's just, you know, it doesn't cost the firm a lot to improve its ES scores with respect to that dimension.
You have 3 minutes left.
Yes, yeah, that's perfect. So I'm just going to have two results to very quickly show you to give you an idea about what we find. So here's our full sample evidence. To give you an idea what the results look like, in the first column here, we just control for the aggregate ES score. So that's an aggregate of you know, several sub-scores. And you see that in that specification, in which we have industry and year fixed effects, we have rating, sort of at a defined level, rating dummies, and additional firm controls, including profitability, size, and other variables. We find a pricing effect, or a coefficient of -18.8. So that means for the firm with the best score, there would be a score of +1. the reduction in the spread by issuing bonds would be in the ballpark of minus 19 basis points. So that's not a large effect, but it's still a sizable effect. And of course, that's the average effect across the entire sample. If we zoom into different buckets of industry or rating groups, then we find we sort of identify situations in which the effect can be much more sizable, much more important. Then the next column basically shows you the individual scores. Again, as I told you earlier, we split up this aggregate score into subcomponents. And here we're highlighting that the product-related subcomponent of this ES score seems to be playing a very important role, followed by the employee-related score that you also see on the slide. And the last minute, let me give you an indication about this time series variation. So here we take basically this model that I just showed you, but we estimate in a rolling way, in a rolling fashion, over like 5-year rolling windows to get an idea about the dynamics. And here you see the solid line is basically the estimated coefficient over time, indicating how it varies. And you would expect, given the sort of the increase in preferences for green investments, or at least we would have expected to see that it sort of has a decreasing trend, which we don't find at all. It's more like flat with a hump in the middle. But then if you look at the dashed line, you also see the supply of high G firms in the sample. And you see that it grows from 40%, that's the right scale on the figure, to almost 80% over the sample period. And that's exactly what I mentioned earlier, is that you see here, there has also been an adjustment, an endogenous adjustment in the supply that of course has an impact on the coefficient estimates that we find. So to conclude, in the last maybe 1 minute that I have, the idea of this paper is to take a careful look at corporate bonds and how the pricing of corporate bonds reflects ES characteristics of issuing companies, because we think it's a very nice laboratory to get relatively clean estimates of the cost of debt and of the expected returns in this area, and because it allows us to talk a little bit about these dynamics and see how firms respond to the pricing patterns in these markets. Thank you very much.
Thank you very much.
My name is Monika Marcinkowska. I come from Poland. I represent University of Łódź, but I'm also a member of EBA's banking stakeholder group. Thank you very much for the invitation to discuss this very, very interesting paper. So first of all, the research concept, I find it really interesting, really important. And what is very important, it has potential policy implications, although they were not explicitly stated in the paper. So I will not repeat the issues that were presented here just a second ago. But what I found very interesting was this theoretical framework that was presented in the paper, and very important recent research questions for which the authors were able to find the answers. The paper is extremely long, so I will not suggest adding anything new to that, but perhaps it would be useful to rearrange some issues, as for example, only the introduction page takes 6 pages. As I mentioned, very important issue, and yes, leave it like that. This was this equilibrium model you've built. To a certain extent, there is a summary of results and literature review. So already in this section, we've got some spoiler of the results. The rest of the paper has a traditional, let's say, structure. So you might consider, first of all, shortening the introduction. Perhaps it would be useful to add a separate literature review section instead of presenting already your results with the background of the literature, and there are certain repetitions in the text of the paper, so you might find the space to shorten it a bit. But I would strongly suggest that you include in the conclusion those policy implications, because there are some. And perhaps it would be useful to also to point some limitations. I will not concentrate on data and methodology, but once again, I would like to stress that I find the results and findings very useful, and and very important, especially this evidence for negative ES credit risk link. Like, for example, you mentioned that there's a novel evidence of corporate E and S performance may reflect credit risk differences not fully captured by ratings and other firm characteristics, and good ESG performance results in a significant reduction in credit risk for risky high yield bonds. So that's why I stress that I find here some place for stressing policy implications. So, for example, this evidence for negative ES credit risk link might be useful in the current debate of the potential prudential treatment of assets with ESG risk. Plus, directly, it shows some market discipline for ESG risk. I have several questions and comments to the authors. I follow the structure of the paper. I quote certain sentences you've included. For example, you've got this assumption of a fixed number of firms. So my question would be whether this assumption is necessary. Could that be abandoned? Then you mentioned two types of bond investors: green investors, and also you say green bonds. So my question was it really only green bonds? But where there also included social sustainability and sustainability-linked bonds, because if not, you might concentrate only on environmental scores and not all of the ES spectrum. I had one problem with the data, with the methodology. Or perhaps I did not understood that well, this presentation. You mentioned that ESG scores, use the ESG scores covering 7 categories, and these are 0-1 dummies, which would suggest the firm is either good or bad, and there's nothing in between. I don't agree with that. I think it could be useful to use some shadows of gray in between. If not, I guess you should point that as a limitation of the study. As a issue of construction of ES score, you haven't even here presented this ES score, and I believe it should be useful to present it in the text itself and not just the appendix. Then you mentioned balance sheet variables. I believe these are financial statements variables, but just the wording probably. And again, the issue of good and bad firms comes back with the overall ES scores. Again, are there no differences between those good and bad? Isn't there anything in between? One further limitation of the study, but perhaps it would be possible now to abandon it, is that you don't have data of the ES data for 2019 and 20. You forward fill it with the data from 2018. I think that specifically for the year 2020, it would be very important, as it was the pandemic year and things could be different then, especially that you show some sub-analysis for crisis periods. So if there is a chance of having that real data, it would be really useful to use it. As to the finding concerning this non-crisis and crisis periods, but also in some other places in the paper you mentioned that scores relating to employees and products behave somewhat different than those concerning community and environment. I have, and yes, you stress thus these challenges to some point, the conventional wisdom. Perhaps there is a different explanation. I believe I'm pretty sure you are familiar with the concept of the pyramid of corporate social responsibility by Carroll. So I think that you can strictly say that product and employees' characteristics are basically connected with those economic and legal responsibilities, and they add up directly to the value creation, while relations with communities and environment, mainly within the area of ethical and discretionary responsibility, which probably might be perceived as too costly during crisis times and thus possible to suspend. Not for this study, but perhaps you could use this data also for another study, because you mentioned strong industry effects. But perhaps it would be an idea for further research, not in this paper, no, to include, to follow some classification from green taxonomy or taxonomies as they differ in the world. As to the time series dynamics of the relevance of ES scores, you mentioned again the structural break in the importance of the employment-related ES dimension. Perhaps there is just not only greater awareness, but also stronger requirements, standards, and regulations concerning this area. And last of my comment was that in the appendix you mentioned that you use mainly a Standard & Poor's rating and supplemented with Moody's. What do you do if, first of all, that was my question, why in this order, and what if those ratings differ? Perhaps that would be useful also to study. So thank you very much. Once again, it was a great study, great research. I'm looking forward for the publication of the paper and for your further research. Thank you very much.
Thank you very much, Monica, for this very detailed discussion and questions. Michel, I'll let you react to some of them, and maybe also to come back to these policy implications. I think that's also a nice angle to take.
Perfect. Thank you very much. Yes, and thank you very much, Monica, for the very detailed discussion and for bringing up these points. So very importantly, let me clarify these ES scores that we create. My apologies for being relatively quick in the presentation and maybe also not very clear in the paper. So these are just normalized scores. So they are a continuous variable between -1 and +1. And it's, it's basically this KLD data is data where firms self-report basically potential concerns and threats to a large number of potential ESG-related concepts. And then, Rue Albuquerque and other people who've used the data basically then came up with a mechanism or proposed an aggregation mechanism to translate all of these potential concerns and threats that firms are identifying into normalized scores between -1 and +1. So they're not just, so there's a lot of gray in between. The firms with +1 are the firms, or is the firm that has the best outcome, so to speak. And that seems with respect, let's say, to a certain dimension, let's say the product score. The firm with a +1 score would be the best firm, so the firm with most strength and least concerns. And the firm with a -1 score would be the worst firm with most concerns and least strength. And the same holds for the other subdimensions. So it's not just binary, but there's a lot of so it's a continuous variable basically, but it's normalized. The language about green and good, as you have seen also from my presentation, I'm also teaching sustainable finance quite a bit, and I'm always struggling a little bit with the right words to use, because good, like very sustainable or firms with high sustainability scores is such a long term that usually one kind of like agrees on or concludes that we call them green or brown firms, or we call them good or polluting firms. So in our case, there's the environmental score or the environmental dimension is one dimension of our analysis. But we also have social aspects in there, and in the model, there's no differentiation, so we just call them green firms, but we basically mean good firms or firms with high ESG scores. And last but not least, on updating the data, I completely agree, that would be fantastic. Our bond data is up to date, but the KLD data has a 2-year lag plus another lag. So if you want to download it from WRDS, the most recent data that you still get is from 2018. which is very disappointing. And so that's a bit of a problem, at least that we face with that database. And finally, come back to the policy implications. I really appreciate that. I agree that we currently don't push that angle very much, but I think it's great to hear from someone who's more involved maybe with policy work that the paper has policy implications. I of course agree, and we will certainly make sure in the next revision that we also sort of link our results more closely to potential policy implications. Thanks again for the comment.
Thank you very much, Michael. So we have some time for questions. I don't see any in the chat, but in the room. No. Yes.
Thank you for the nice paper presentation. Just maybe a clarification question. How much within variability do you observe in your ES scores? So basically, would you be able to identify an effect of ES scores on the yields in the primary market if you plug in firm fixed effect?
Thanks for the question. So the first answer is yes. So currently we revised the paper, and we also have now empirical results with actually issue-specific fixed effects, and the results go through. So even that works. So basically within issue variation across time. In general, of course, there is variation across the different dimensions of the ES scores with respect to how much variability there is. And so, for example, with respect to, I think, community, we observe in our sample relatively little variation and also high levels overall. While, for example, with respect to the environment, we observe much more variation. And we, in our interpretation, link this also to this notion that potentially, given our firms are firms that issue large corporate bonds and they're listed, right? Because they are, we match them with CompuStat, so these are large firms. And they might find it relatively easy to score well on the community dimension, but depending on their industry and other characteristics, they struggle more or have higher adjustment costs with respect to their environmental dimension. So that's certainly something that matters here a lot and is not homogeneous across the different dimensions of ES, of E and S. Does that make sense?
Yes. So thank you very much, Michel, for the excellent presentation. Thanks, Monica, for the very good discussion and the